Happy Monday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Monday, February 26th, 2024. Happy birthday, Mom. Happy birthday, Azaria, my niece. So it's a great day. So we'll start with our executive summary for today. As always, if you like the analysis supporting these conclusions, as well as what to specifically do about them in your portfolio, you need to be a client of 42 Macro. So today's key macro event is to broaden out or to not broaden out. That is the question. So the nuance there is U.S. stock market concentration as measured by the relative price of the S&P 500 to the S&P 500 equal weight index is at the highest level since 2009, surpassing the highs of 2020. Elsewhere, this week's key macro events are highlighted by the February PC report on Thursday. Per Bloomberg survey of Wall Street economists, the headline PC deflator is expected to accelerate 0.3% month over month from 0.2% prior, while the core PC deflator is expected to double to 0.4% month over month. In terms of market implications, while AI has every right to bubble in a reflation market regime, the longer reflation persists, the more likely we observe a broadening out of participation into global equities and real economy cyclical factors. Elsewhere, the recent slew of marginally hawkish forward guidance has de-risked the PC report somewhat via the hawkish repricing in U.S. dollar money markets. The modal outcome, according to Fed Funds Futures, is 3 rate cuts in 2024, in line with the latest FOMC dot plot. As discussed last week, we do not believe the current risk-on market regime requires rate cuts to persist for a while because the resilient U.S. economy theme we authored in the summer of 2022 persists. Transitioning to my 42 macro dashboard, as always, we'll start with trading range signals from our friends over at Longbow. We're getting wrong click there. Getting a near oversold signal here in crude oil for those who maybe want to be allocating the energy as a way to play a broadening out of reflation participation. And then we're getting an overbought signal in gold, which is exactly the kind of exposure you would not want to be exposed to in reflation, certainly relative to the other alternatives in the commodities, currency space. And then lastly, as always, wrapping up with a question from our community, getting a question here from a client regarding financial repression. So I'll just read the question. So if financial repression means that the government forces savers into lower interest rates in spite of higher levels of inflation, would this have an effect on putting upward pressure on spreads of non-treasury debt, or would it put downward pressure on spreads? So that's a simple answer. The answer is it'll put downward pressure on spreads, because what happens in financial repression is the government, vis-a-vis balance sheet policy of the central bank or some other regulatory scheme, i.e. forcing commercial banks into the treasury market, they put downward pressure on sovereign debt yields, on treasury yields and they hold them artificially lower than they would otherwise be if they were just truly set by market forces. And those artificially low rates cause investors, particularly global capital allocators, to reach for yield further out on the risk spectrum, thus decreasing the spreads for spread products like credit, spread products like emerging market debt, loans, etc. So this is exactly what happens in QE. QE is a financial repression policy. And so if you think you're going to see financial repression, incremental financial repression, as I suspect we will, as we progress deeper into this fourth turning, which may persist for the next decade or so, we would expect to see spreads narrow. But it doesn't mean that the yield levels are going to go down. The yield levels can be rising, but spreads can be compressing as yields rise. So just be aware of that in terms of the absolute return risk in fixed income asset classes. So we'll wrap it up there. Darius Dale presenting our macro minute for Monday, February 26th, 2024. Everyone have a great day, great week, and we'll catch you back here tomorrow. Cheers.